This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session, I left you with not only some revision and some further rereading to do, but also with an example to have a go at as well, which hopefully now you have both performed and checked out with that model answer at the back, which I'll review through with you in a moment's time. Just to remind you there, we saw a situation where in the 2021 tax year, Tina had made disposals of 3 assets. Of those 3 assets, 2 of them gave rise to gains, 1 gave rise to a loss. In terms of the type of asset we were dealing with, we got a painting in there, we got a commercial investment property, and an antique vase. All of those 3 are chargeable assets. As we said, 2 gains arise and 1 loss, but in terms of the tax rates that will be applicable, it's the same. These are other assets as compared to residential property, or assets that would indeed rank for business asset disposal relief or investors relief there. So on that basis, we are going to be looking at just one set of tax rates. It's either 10% if we're basic rate, and then anything above that into higher rate will be 20% CGT rate. Let's have a little look at the answer therefore and see how we fared. In terms of the calculations of the gains and losses themselves, well, I would hope not too much difficulty there. We knew our disposal proceeds in relation to the painting, we knew our cost, and therefore it's an easy calculation of the gain. The investment commercial property. Now I keep emphasising commercial property. Had this been residential, then the calculation of the gain itself would not have changed. It would be exactly the same. It always is. What are our disposal proceeds, and what are the allowable costs that we have incurred to set against that, and establish the gain accordingly. But if we had a gain on a residential property, then we'd have to keep that separate to any other gains on any other assets, because residential property has its own separate tax rates. More of that, though, later, because it wasn't applicable here. This is commercial, and therefore it's subject to the normal CGT rates of 10 and 20%. As we'll discover here, 20% of course, because the taxpayer, we'd already determined from a first read through the question, the taxpayer was a higher rate taxpayer. But simple calculations, again, the disposal proceeds less any selling expenses to get net proceeds, take away the cost, and you end up hopefully with a gain of £95,300 there. With the antique vase, it didn't prove to be such a good investment. We end up with a capital loss of £5,000. Put it all together to establish in the 2021 tax year, we have net gains of just over £240,000. We must take away, of course, our AEA first of all. That's our £12,300 for the 2021 tax year. And then, as we have given information about it, there are some brought forward capital losses there that are dwarfed by the extent of the now net gain for the year, and on that basis are fully absorbed, giving us again a huge figure of taxable gains of some £213,000. Now, as we said, Tina's taxable income was such that we exceeded the basic rate band limit. Tina is a higher rate taxpayer for the tax year, and on that basis, all of the taxable gains will be taxed at 20%. As a higher rate taxpayer, the higher CGT rate of 20% applies. Now, what we can see in this example is because each of these assets giving rise to gains, the painting and the commercial property, because the same CGT rates are, well, here it was 20%, otherwise 10 and or 20% there would apply. It's the same rates. So we were able to do one overall calculation, adding these 2 gains together and then taking away that loss from that total of the gains. Understand that if this had been not commercial but residential, then residential property gains in the higher rate band wouldn't be taxed at 20, they'd be taxed at 28%. So on that basis, when it comes to deducting that loss, where would we have deducted it? We'd have had separate columns here for the two gains made. Our residential property separated out from any other assets. That was just the painting, the only other one that we made a gain on. And now we've got the loss on the antique vase. Well, where would you want to make that deduction? Which gain would you rather reduce? The gain on the painting or the gain on the now residential property? Well, if it was a residential property, it's 28%. As a painting, it's just 20%. So very clearly, you would be deducting the capital loss of £5,000 away from the gain suffering tax at the highest CGT rate on a residential property. If it were that, that would be 28% as compared to the painting, or as we see in this question and the answer to it, it's only 20%. Not an issue here because both gains were subjected to the same tax rates. But watch out for that. Had I just changed it to residential property there, then we'd need to keep that gain separate from any other, and we would allocate any losses and indeed any AEA from those particular gains on residential property. We've mentioned that with the loss, the same would hold true in relation to the AEA. Again, if you can't recall this from the previous session, go back, look at your notes, see where those deductions, those losses and the AEA, where do they go? They will reduce the gains that are to be taxed at the highest tax rate. That's residential property as compared to other assets. Again, here though, we got our taxable gains in a single calculation, all of it at 20%. Why? Because the taxpayer is a higher rate taxpayer. So should therefore be no problems on that. Let's go back to the notes therefore now. And moving on from that, we come to, well, a little bit of exam technique. In any examination that you sit, given the nature of objective testing questions, there are always going to be some questions that you cannot deal with. We have a very big syllabus. There's a huge amount of detail. So we can't legislate, nor must we worry about dealing with every possible question. But what you must do in terms of exam technique is to ensure that if you do have the knowledge to be able to correctly answer any individual question, that you use that knowledge in the right way and secure the right answer and therefore the marks. There is nothing more infuriating, more costly in terms of your exam performance than if you forego, you give up marks that you could and you should have scored. Now, if you've done the reading that you'll see on the screen in front of you here, based on the things I've already told you so far, we see here a perfect illustration of where, although students will possess the knowledge to get questions right, they will make silly mistakes and therefore miss out on those marks that they could and should have scored. This is the type of error that you have to ensure that you deal with and you do not make these mistakes in the exam. And most of this comes down to not rushing the question. Too many people do not look in detail at the requirement of the question or indeed fully understand the information provided within the question. In their haste to press buttons on the calculator, which they do very quickly, they don't always press the right buttons. Or if they do, they don't always go to the end result that is required of them. So it is critical, therefore, that you read the information in the question and analyse the precise requirements of that question very carefully. Only when you have decided that you know exactly what needs to be done and the means by which to do it, do you then proceed to start pressing those buttons on your calculators, but do not rush in. So, as you will hopefully have read since last time, we can see here that, again, when we're dealing with calculations of CGT, it is even more important than ever to ensure that you properly read and understand the information provided in the question. Now, here are the typical examples. Does the question give you the figure of taxable gains? In the exercises that we've done so far, I'll be giving you both taxable gains and taxable income. And that was then used as the basis from which you could then compute the CGT liability. Now, you know that taxable gains is after having deducted any capital losses and, of course, your AEA for the tax year. So, does the question give you the figure of taxable gains, or does the question tell you the chargeable gains and you then have to compute the taxable gains? They might give you the net gains of the year. Those net gains, gains less losses, will be before deducting any AEA. You have to deduct the AEA away from the net gains to be able to establish taxable gains. Obviously, if you have capital losses brought forward as well, then those two must at the very end be dealt with, if of course there's anything to deduct them from at that point in time. But what you may get is taxable gains, so that's the figure after AEA, or net gains, which is before any deduction of AEA. So it is also going back to Chapter 2 under your understanding and awareness of the structure of the income tax computation. Again, up until now in these exercises, we've been looking at a figure of taxable income of the taxpayer. Bottom line, taxable income on that first part of the income tax computation before moving into the tax liability calculation. Now that bit of course is not required here in CGT, but we do need the taxable income figure. Now you may be lucky, and they may, as I have up until now anyway, just given that figure to you. That taxable income figure is therefore after having deducted any personal allowance of the taxpayer for the tax year. So does it give you the taxable income of the taxpayer for the tax year, or are you simply provided with income figures that require you then to deduct the personal allowance of the taxpayer to compute the taxable income? So net gains, not the same as taxable gains. Net income, not the same as taxable income. We will need, if a CGT liability is required of you to compute, we will need to know taxable gains, taxable income. Do they give you those figures as a starting point, or do they give you net income and net gains from which you respectively deduct your personal allowance and your AEA? Make sure you interpret that information correctly. I've received on the Ask the Tutor questions forum many questions over the years where someone say, why have we deducted the AEA, or why haven't we deducted the AEA? Why have we deducted the personal allowance, or why haven't we deducted the personal allowance? Simply based on students not having read the information provided within the question. So make sure you get that right. In addition, read carefully, as we've said, the requirement of the question to ensure that you're actually answering the question's the correct requirement. So, for example, does it actually ask you to calculate the CGT liability? We'd probably expect it would do, of the taxpayer, or simply to compute the taxable gains of the taxpayer. They may give you individual assets with market values and or sale proceeds there, your allowable costs, and you've simply got to work out what the net gains of the year might be, and then the taxable gains after deducting any AEA. They don't necessarily always ask you to compute the CGT liability, so make sure you're answering the correct requirement. Does the requirement ask you to compute the taxable gains after AEA and losses brought forward, or simply the chargeable gains before AEA and losses brought forward? Again, what do they want? Do they want taxable gains? Do they just want net chargeable gains? Do they want CGT liability? Make sure you correctly interpret the requirement. So, as we've said, you do not rush into those calculations. You don't waste time either. It's an exam. There is a strict time allocation, of course, to be adhered to. But you make sure before you start to jot things down, calculations down, press buttons on your calculator, make sure that you know what needs to be done. You've correctly interpreted, well, at least as best you can. So time to make sure, therefore, that we can correctly interpret the requirement, achieve that requirement by establishing from the information given in the question what is relevant to us. We have examples 2 and 3 here to practice on, and in each case it's a tax liability that needs to be computed. We want for Matthew to begin with the CGT for 21-22, and then for Katie the CGT liability also for 21-22 tax year. Our tax year for the exams coming up in June 22 through to March 23 there. So what are we told firstly in example 2? We're told that we've got a trading profit of £20,000 to be assessed in 21-22, and we've sold an antique vase giving rise to a capital gain of £18,300. So to compute a CGT liability, we need to know taxable gains. Well, that's simple enough. We've got a capital gain of £18,300. It seems to be a single chargeable disposal made in the tax year. So what we've got to do to work out our taxable gain is to deduct from that gain of £12,300 our AEA of £12,300. And that therefore will equal our taxable gain. Clearly not a big number. It's going to be, what, £6,000 there of taxable gain. The question then is, what have we sold? Will it be entitled by the nature of the asset in question to any lower preferential CGT rates? And of course, what is the taxable income of the taxpayer based on the income tax computation for the self-same year? Well, that income tax computation is going to show just one figure of income there, £20,000 of trading income. We need to get the taxable income, so we need to deduct from that the personal allowance of £12,570. And that therefore is clearly going to mean that we've got a very low figure of taxable income, nowhere near the basic rate band limit of some £37,700 as it is for our 21-22 tax year. And with a taxable gain of just £6,000, all of that is going to fall into the basic rate band that still remains after accounting for the taxable income in the income tax computation. And then we look at the asset being sold. It's an antique vase. This is not, therefore, an asset that is going to rank for either business asset disposal relief or investors relief. And equally, it's not residential property to have, therefore, the higher CGT rates that are applicable to residential property. So this is just an other asset. Again, there was mention as regards about certain assets that might be exempt, chattels, back in our first lecture together. There's no exemption that will apply here. The ones that do and how they do and how we deal with them, that awaits us in just a slightly later lecture within this chapter. So all you need to do, therefore, is to get that taxable gain, it's 6,000, and to apply the relevant CGT rate, knowing it's just an other asset that's being disposed of, and it's all going to fall within the basic rate band. Example 3, again, CGT liability. It's a commercial investment property. Now, important word there, it's a commercial property. Commercial means it's not residential, so we're not going to suffer the higher residential property CGT rates. It's an investment property, which again doesn't mean that much to us at this point in time, but it isn't therefore going to rank for business asset disposal relief and therefore benefit from a lower tax rate. So what have we got? We've got a capital gain of 30,300. We know we'll take away from that again, or rather you will, the AEA of 12,300 to get the taxable gain figure, a somewhat larger figure than we have there for example 2. We've also got for Katie a trading profit of 41,000, so more income here. And from that we have to take away our personal allowance again of £12,570 to get that taxable income. So you're going to have to find out here how much basic rate band remains after we've dealt with the income tax computation. We don't care what the income tax liability is. We just need to know the taxable income by comparison to the basic rate band limit, and therefore what amount of that basic rate band remains, to know whether the taxable gains will just be taxed at the lower or the higher rates. Over to you, therefore, to solve those problems, and we'll talk through that in a moment's time. Well, I'm hoping no problems here in terms of working out the CGT liability for each of the two taxpayers in first example 2 and then example 3. Again, as we said, to work out the CGT liability, we needed to know what the taxable gains figure was, and that, of course, was an easy £6,000 to compute. They hadn't given us taxable gain, they'd given us the gain. We deduct the AEA for our tax year. It was then a question of what tax rate would apply to that taxable gain. Now, as we can see, for that we need to know, as well as what asset is it that is being disposed of, what is our taxable income figure. And when we take away the personal allowance from the relatively small trading income figure, we get a taxable income of only £7,430. So very, very obviously, and without bothering, of course, in a 2-mark objective testing question to do any workings on this, but we know that the basic rate band remaining is a lot bigger than that taxable gain, and hence all of that taxable gain will be taxed at the lower rate of 10%. There's the calculation, 37,700 limit minus the taxable income that the income tax computation will have absorbed, and that gives us over £30,000 worth of basic rate band that remains. The taxable gain of £6,000 obviously therefore all falls within the remaining basic rate band, so it's a 10% tax charge that will apply. As we've said, it's not a residential property, it's a commercial property, so the higher residential property rates do not apply. It says here, if the taxable income of the taxpayer had been £32,700, then only £5,000 of the basic rate band would remain. This calculation would have read 37,700 minus 32,700, and that therefore would have given us 5,000 basic rate band. And that, of course, would mean when we taxed our taxable gain of 6,000, something going wrong with the machinery here, things keep moving around. But when we calculated that gain, we'd have £5,000 of it to be taxed at the lower rate, and then, of course, that would push £1,000 of the taxable gain into the higher rate band of 20% there. But as it stood, it was all at 10%. With example 3, again, we seem to have a little bit of a problem in terms of the presentation of this. Don't know what's gone wrong with it. But we've got capital gain 30,300, AEA 12,300. So although it's disappeared here, that presumably is a taxable gain of some £18,000 there. There it is, £18,000 of taxable gain. Right. How much of that is going to fall into the basic rate band, and will any of it fall into the higher rate band? Well, yes, because we've got a much bigger figure than example 2, we end up with taxable income, having taken the personal allowance away from the trading profit figure, a taxable income of 28,430. That therefore means that 37,700 the basic rate band, 28,430 of it used in our income tax computation, it leaves just £9,270 of that basic rate band remaining. So that 9,270 out of the £18,000 of taxable gains will be taxed at 10%. And the remaining balance, hopefully that figure there, 8,730, that's pushed into the higher rate at 20% and calculate the CGT accordingly there. Okay, a little bit more interesting that one than example 2, because it did mean that we had to do a split calculation of the CGT liability, with only some of it falling into the lower rate, because it's within the basic rate band limit still, and some of it falling into the higher rate there, because we become a higher rate taxpayer as a result of adding in those taxable gains into the figure already of taxable income off the income tax computation. Back to our examples. Next one up, they're coming thick and fast now. Calculate, again, it's a CGT liability that we need for this taxpayer Elliot. and it's for the 21-22 tax year. Again, we're looking at a significant amount of trading profit being assessed in 21-22, again from which you'll deduct the personal allowance to get your taxable income. In addition, sold a painting, giving rise to a capital gain of 26.3, again therefore a significant amount of capital gain. We'll be taking, of course, our AEA away from that in order to establish the taxable gain, but then a new component thrown into the action here. And that is that Elliot made a gift aid payment of £2,400 in 21-22. A gift aid payment. Now, the relevance of that, it means, of course, that in the income tax computation, although when we took that personal allowance of 12,570 away from the trading income of 45,270, we would still remain just a basic rate taxpayer. We wouldn't have exceeded the basic rate band limit. We know that when we get gift aid payments, we extend that basic rate band limit. And what do we extend it by? The gross amount of the gift aid payment. Now, we're told we made a gift aid payment. That is what we actually paid, 2,400. So you'll need to gross that up times 100 over 80 and then extend the basic rate band limit, the 37,700, by that gross figure. Now, it didn't matter on the income tax computation because the taxable income, as we've just said, would have been below 37,700. So it wasn't relevant on the income tax computation, the existence of that gift aid payment. But it is relevant now for the calculation of your CGT liability, because we're going to extend that basic rate band limit from 37,700 up by the gross amount of that gift aid payment. And that will mean more of our taxable gain will then be able to be taxed at that lower rate of CGT, at our 10% instead of our 20% rate. Again, we're dealing with a painting. This is just an other asset. There's no higher or lower rates that may be available for us in relation to that. So over to you now. Compute the taxable gain, compute the taxable income, establish with a revision of the basic rate band limit what remaining basic rate band remains, and then proceed to tax as usual the taxable gain as much as you can within that remaining basic rate band, and the rest of it pushed into the higher rate of 20%. Pause again at this particular point, please, and then we'll come back and check it out together. Okay, well, normal first moves, having determined what the requirement is to compute that CGT liability again, establish the taxable gain if not already given. Well, it wasn't. We were told the gain that arose, so we have to deduct our available AEA to get that figure of taxable gain there. To be able to tax it, again, we need to know what asset it is as regards whether any specific, either lower or higher rates may apply as compared to your ordinary rates. And we also need to know off the income tax computation here in working one, what was our taxable income? Well, we took our trading income less our personal allowance, and that gave us the taxable income of 32,700. Now, ordinarily, you'd have just compared that with a basic rate band limit of 37,700 minus 32,700, and that therefore would have been some £5,000 worth of basic rate band that remained. But there was a different component in here, as we said, and that was the gift aid payment. And what happens is that the gross amount of the gift aid payment, had we get that, what was actually paid times 100 over 80, extends that ordinary basic rate band limit of 37,700. Well, that grossed up gift aid payment equals 3,000, added on to 37,700, and we get £40,700. Using your revised and extended basic rate band limit of 40,700, take away the figure of taxable income off the income tax computation, and that leaves, therefore, instead of 5,000, now some £8,000 of basic rate band remaining. Therefore, in our CGT calculation that now we can go back to, The first £8,000 of the £14,000 of taxable gains will be taxed at the lower rate of 10%, but it still leaves out of the £14,000 £6,000 that pushed up into the higher rate of 20%. Do the calculations and we'll establish, therefore, as ever, what the CGT liability will be due for this particular tax year. Okay, so a bit more interesting there, because we had to remember from our income tax knowledge on the income tax computation, we extend the basic rate band limit by the gross amount of the gift aid payment. That would be equally, of course, as true if we had had any personal pension contributions being paid in the tax year, then they too, having been paid net, be grossed up by the 100 over 80, and they too would extend that basic rate band limit. Back to our notes and one further example here for you to have a go at now. Example 5. Gainer has a trading profit assessment of 21,770. Oops, what should I have done first? Looked at the requirement, the CGT liability. Again, of course, as all of these have been for the tax year for us 21-22. Trading profit assessment 21,770, no other taxable income. She sold 2 assets during the tax year. A residential investment property. At last, a residential property. What that means, of course, as being residential, is we're looking at the higher rates of CGT. Instead of the lower rates of 10 and 20, it's now going to be 18 and 28% that apply. The use of the word there, investment, we haven't dealt with this as yet, but we know from our chapters that we've seen that chapter 14 deals with various reliefs. We've made mention of business asset disposal relief, and we've made mention of investors relief there. But another one is known as private residence relief. Because if it was the property that you actually lived in, and all you'd ever done was live in that, then all of any gain that may have been made would be eligible for private residence relief, and that would remove any gain from being taxed. So by them putting in here investment property, it means it's not your private residence, and on that basis there's no relief available to effectively exempt that gain on that property. So it is going to be a chargeable gain that needs to be computed. It will be taxed. Being residential property, going to be the higher rates, of course, that are applicable. And we've got there a chargeable gain of £30,300. But there were 2 assets being sold. Another one, of course, is just another one of those other assets, a diamond ring there, yielding a chargeable gain of £12,000. Must be a big diamond. A chargeable gain of £12,000 there. Now, that is just an other asset. So it's the lower CGT rates that apply. So if we have a situation where, as we will here, we have trading profit of 21,770, no other taxable income, so that will be minus the personal allowance of 12,570 there. But we've got gains of 30,300 and 12,000, even though our taxable income is very low, 21,770 minus 12,570 there. We will still see that the combination of those 2 gains, the total taxable gains, will use up the remainder of the basic rate band limit that is available to us. And some of it will then go into the higher rates. But what we have is a situation where we've got 2 gains, one residential property that is taxable at the higher rates, the other an other asset, the diamond ring, taxable at the lower rates. But of course those gains added together is not the amount of taxable gain. We have, as ever, our AEA available. So you now have another question to answer. And that, of course, is against which of those 2 gains would I prefer to deduct my AEA. Which of those two gains, the one being taxed at higher rates or the one being taxed at lower rates, would I like to exempt? I think we know the answer to that. You would prefer to exempt any of the gains that would be taxed at the higher rates. So you would put that AEA against the gain arising on the residential property. That will exempt as much of that as we can, and also then mean that hopefully the remaining bit of taxable gain may fall in the lower of the two rates, the 18 rather than the 28%. But the main thing is you've exempted a gain that would have been taxed at the higher rates, whether that was 18 instead of 10, or whether it was 20 instead of 28, or 28 instead of 20. You have exempted the gains that are going to be taxed at the higher rates. And that's what you would do with any annual exempt amount, or indeed in another example, any capital losses that you might have available to you. Which gains do you want to reduce? Very obviously, gains that would be taxable at the higher CGT rates. And thankfully, that's exactly what we're able to do here. So put that annual exempt amount against the gain on the residential property. Get your two taxable gains and then proceed to tax those gains with what remains of your basic rate band limit and then whatever is pushed out of that up into your higher rate. Okay, have a go at that. Think it through carefully, do your workings accurately, and then we'll come back again and look at it together. Okay, well, let's see how we got on with this more interesting problem, but hopefully from what we said when we talked you through the information of the question, again, we've come out with the correct answer. Rather than now just a single calculation of the overall taxable gains, we've split it. We've split it into what was the residential property gain, a figure given of 30,300, and what was just other assets there, and that was 12,000. And the reason why we've split it is that any amount of either AEA or capital losses that may be available to us are going to go against, as we will choose to put them against as a priority, those gains, i.e. here the residential property, that will be taxed at higher CGT rates, 18% and 28%, rather than 10% and 20%. So in note 1, we can see what we discussed in looking through that question. The AEA is deducted firstly from the gain on the residential property, as it would be subject to CGT rates of 18 and 28%, as we've said, whereas the gain on the diamond ring would only be subject to the lower rates, the lower rate of 10% and its respective higher rate of 20. But 10 and 20 is a lot lower than 18 and 28. So having got the individual figures of taxable gains on these two categories of asset, the residential property and the other assets there, we then need to establish the CGT. To do that, of course, we need to know, in addition to what we already know about, well, the differing rates here, residential property compared to other assets, we need to know the taxable income for the taxpayer off the income tax computation. So we had, therefore, 21,770 of income minus the personal allowance, and that would appear to be £9,200, therefore, of taxable income. So that would leave an unused basic rate band of, well, should be 28,500, it being the basic rate band limit of 37,700, no extension here, no gift aid payments, no personal pension contributions paid during the tax year. 37,700 minus what we have used up in relation to the income tax computation and the taxable income there of 9,200. And that should be, again, do check, £28,500 as the outcome. As we've got a gain of 18,000 on the residential property, that could fall entirely, therefore, within the remaining basic rate band of 28,500 and would be taxed at 18%. That will be taxed at 18%. It's the higher of the rates, but within that basic rate band, it's going to be 18 instead of 28% there. What will that still leave? Well, we had 28.5 left over of the basic rate band following the income tax computation. We've used 18,000, so that therefore leaves us with £10,500 of the remaining basic rate band to apply against the gain on the diamond ring. So in which case, therefore, with our diamond ring, we've now got the first 10,500, as we've earmarked here, to go at the lower rate of 10%, and the remaining £1,500 of the £12,000 gain made at the higher rate of 20%. Establish those capital gains tax figures for each asset, put them together, and we should end up therefore with an overall CGT liability of £4,590. Now, what you've seen that we have done is, as we must and should do, and it's better for us, any deductions like the AEA or capital losses, put them against any gain that would be taxed at the higher CGT rates, to get then individual taxable gains in those respective rate bands. What is residential property from what are other assets there. But then we've taxed the 18,000 remaining taxable gain on the property first, and then put the remainder of the basic rate band still remaining, and then the little bit into higher rate, we allocated that to the ring and got those two calculations there. You might be wondering, well, is that what you always do? It probably will be, but it doesn't matter. Because once you have correctly deducted any capital losses and the AEA from those gains suffering CGT at, as we keep emphasising, the highest rates, and computed the resulting taxable gains, it will not then matter whether, as above, what we've firstly done is to tax the gain on the residential property, or whether you were firstly to tax the gain on the diamond ring. The reason being is the difference between the higher and the lower rates in both cases is the same. It's 10%. It's 10% compared to 18. It's 10% compared to 20%. It's 18 compared to 28. So there's a differential of 10% between each set of lower and higher rates. So it doesn't matter which you use first. Now, you'd never bother to do this, but I know students always ask the question, well, are you sure about that? So I've just done a little proof there. You'd never be doing this in the exam. It doesn't matter what order you do it in, but you'd probably just do as I have done there in that first answer, where we've gone with the 18,000 gain on the property first, but it does not matter. The proof is shown there. If I went with the diamond ring first of all, the gain of 12,000, all of that is clearly within the remaining basic rate band limit, so all of it gets the lower rate of 10% as it's an other asset. Then in with the residential property, there is £16,500 worth of basic rate band remaining, so using the lower rate now for residential property, that's 18, with 1,500 remaining, and that's the higher rate of 28%. Work through the individual tax figures, and well, shouldn't be any huge surprise from what I've just said, of course, that is exactly the same figure. So it does not matter. So don't start worrying, oh, do I have to do these tax calculations in a specific order? No, you don't. But what you do, what you must remember to do is when you take these deductions out, be it AEA and possibly losses there, we go against those gains taxable at the highest CGT rates. Let's get the best use out of these deductions as we possibly can, i.e. reducing gains that whether they're in the lower or in the higher rate bands here, it doesn't matter, they are going to be taxed at a higher rate than any other assets would be taxed. So get the benefit of the deductions against those gains first of all. Okay, that brings this particular session to an end, and we'll continue with this quite extensive chapter, of course, here on our Introduction to CGT in our next lecture together.